In this video, we're going to talk about Cathie Wood's market crash predictions. Before starting the video, please do like it and subscribe to the channel for future updates. Cathie Wood is a top stock picker and the founder of ARK Invest, ARKK, a hedge fund manager that manages tens of billions of dollars and invests mostly in cutting-edge technology businesses like Tesla, TSLA, Teladoc, TDoc, and even Coinbase, Coin. She rose to prominence in 2020 after providing huge returns to investors during the pandemic. However, her recent record has been underwhelming, prompting many investors to doubt her stock-picking talents. In her defense, she is a thematic portfolio manager, and her industry has experienced unprecedented selling. I believe we have overhyped her in 2020, but we have also placed far too much blame on her today. After all, short-term market results are impossible to predict, and no one is immune to a market meltdown. Regardless of your feelings about her stock picks, it's worth paying attention to what she has to say about the economy because she has access to some of the best resources in the industry. When you manage such a large sum of money, you just have more knowledge than the typical Joe. And so what is she saying right now? She says that we're in the midst of a worldwide recession. She points out that there's worrying data coming out of China and Europe that could herald the beginnings of a downturn. The latest GDP statistic in the United States confirms this, with a dip of 1.4% in the first quarter, significantly below predictions. Of course, there are various reasons to assume we are in a downturn. High inflation, supply chain issues, a lingering epidemic, a tremendous geopolitical uncertainty are all putting a damper on GDP. This is particularly troubling given that we are only at the beginning to see a raise in interest rates, and we're already talking about a recession. The Fed recently lifted rates by 50 base points, the greatest rise in 22 years, while the rate remains in the 0.75 to 1% range. We're in a predicament because we all have to choose between having high inflation or a recession. Raising rates significantly would surely alleviate inflationary pressures, but it would also throw the country into a recession as they retake control of inflation. Jerome Powell just reiterated this by stressing that he can't promise a smooth landing. It may appear like we're in for more pain in either case, which is why the market has been so volatile recently. What changes should investors make to their portfolios in light of the unusual situation? Cathie Wood believes that now is the time to invest in new digital companies that can develop despite inflation or a downturn. After the recent sell-off, I agree that there were some chances in this space. However, I continue to invest the majority of my money in real estate investment trusts, or REITs for short, VNQ, because many of them provided exactly what you need in today's market: inflation protection and recession resistance. I'll highlight two top picks that I'm currently accumulating in the following paragraphs: BSR REIT OTCPK BSRTF HOM.U. Apartment REITs were a popular investment for much of the last year, and it's easy to see why, because everyone needs a roof over their head and rents are rising at the quickest rate in 15 years. They provide inflation protection and recession resistance. That's not all, though. The fact that these REITs are able to get fixed-rate loans at relatively low rates and with long maturities adds to their appeal. Because the debt is now being inflated away while the value of their assets continues to rise, this provides extra security against inflation and rising rates. Furthermore, rising interest rates benefit these REITs since home ownership is becoming more expensive, increasing demand for flats, while new building projects become less profitable, reducing new supply. As a result of these factors, we should expect these REITs to have solid fundamentals in the coming years, thanks to part in rising inflation and interest rates. Despite this, some apartment REITs are now surprisingly affordable. BSR REIT OTC PK BSRTF HOM.U is one of my favorite instances because it owns mostly assets in fast-rising Texan cities like Austin, Houston, and Dallas. I prefer BSR to most other large apartment REITs like Equity Residential EQR or Essex ESS. Many people and businesses are migrating there now to decrease their living costs and taxes, and I don't see this trend slowing down anytime soon. Rent hikes of 20% or more and cap rate compression boosted the portfolio's worth significantly last year. Its net asset value increased by 61% to about $20 per share. All of this happened in a single year. In 2022, growth will likely be slower, but it will still occur because BSR hasn't yet bumped all of its leases. BSR has initially valued at $22 per share, which made reasonable given its promising potential, but as the market fell, BSR fell back to $16.50 per share. For highly coveted inflation and recession-resistant assets, that's a 15% discount to NAV. I anticipate that if BSR continues to record significant rent increase for the next quarters, its NAV will reach $22 to $25 by the end of the year, resulting in a 30 to 50% gain from today's share price. While you wait, you'll get a 3.2% monthly dividend yield that's steadily increasing. Is BSR the most profitable REIT in our holdings? No, it's not. However, it offers important inflation and recession protection, and it's currently at its lowest price in a long time. Vici Properties, VICI. Vici Properties is the largest casino REIT, and while this may come as no surprise, it's also one of the strongest inflation and recession hedges available today. Many people believe that casinos are very cyclical. However, this is not the case. Gambling, like many other crimes, is resistant to cycles because it provides people with an escape. Vici, on the other hand, is recession-proof because it is a triple net landlord. This implies it rents its properties to tenants for a long period of time, and the tenants are responsible for all the property expenses, including maintenance. The leases are for a term of 15 years or more, and the rent is preset for that duration, with automatic annual rate increases. As a result, whether or not we enter a recession, Vici can count on constant cash flow from its rent checks. If you're still skeptical, remember that during the pandemic, Vici did not miss a single rent payment and was able to increase its dividend by 11% in 2020 and another 9% in 2021. Even the worst-case scenario for Vici, the pandemic, could not derail its revenues. In addition, Vici's leases include CPI adjustments, which give further security in the event of high inflation. For example, its Caesars CZR lease, which accounts for more than 40% of its rent roll, will increase by the greater of 2% or the change in CPI, with no cap on the growth in CPI, ensuring that the revenue stream is inflation protected. The idea here is that Vici may expect high rent increase during periods of inflation, and because it's not liable for any property expenses, this is a genuine growth that goes right to the bottom line. In today's context, such a quickly rising inflation and recession-resistant REIT would be expected to trade at a high valuation, but because it is mistakenly seen as a risky casino investment, it is now priced at just 12.5x FFO and delivers a well-covered 5.3% dividend yield. You can anticipate to make 12% annual returns only from the yield and growth. And once Vici returns to fair value, I expect another 30% increase from the present share price. What is the driving force? In the near future, Vici is projected to be included in the S&P 500 SPY. Closing note. The major problem for today's investors is to select investments that can safeguard them against both a recession and inflation. The Fed is obligated to raise rates in order to bring inflation under control, yet doing so will almost certainly lead to a recession. We feel that inflation and recession-resistant REITs like BSR and Vici offer the best risk to reward in today's market, and this is where we currently put the majority of our cash. So what do you think about today's video? Let us know in the comment box below, and please do like the video and subscribe to our channel for future updates.